So in this video, I want to talk about composite rating in the small group ACA market and how it can lead to a lot of cost variation for your small employer clients. So this video is for health insurance brokers, particularly those in the small group market. What we're doing here is that we're creating a model or a simulation of the side-by-side effect of running age-banded rates and composite rates. And so just to give you a sense of what we're doing here, we have created some hypothetical values. We created an age rate table that will be used to calculate the age rated prices for health insurance in small group. And then we created a hypothetical census. This is a rolling census of about 13 employees and their dependents. We have all the information we need to run quotes, date of birth to calculate ages, that kind of thing. And then we have this enrollment and termination column where we can simulate the turnover effect of employees hiring and then leaving employment with the employer and how that's going to change population, demographics, and how that will affect cost under composite rating. So just to jump into the analysis so that you can kind of understand what I'm talking about here, this is a look at taking that census and those rates and creating some kind of an experience of January 1st, 2021. And for the sake of analysis, this is the start of the plan year for this hypothetical employer. So what we have on this table is we have the employee. We've pulled the dependents off this table, but their data is still being used under the hood to calculate the values here. The employee's age in this column, we've established their tier, so which composite tier do they belong to, family count just for the sake of knowing, and then we have their enrollment date and termination date. And then we've calculated the age-rated premium in this column here, and then the composite rates in this column here. And there's something to know about composite rates. The information we're sharing here, by the way, this only applies to ACA small group composite rates. It does not apply to fully insured, self-funded, or level-funded, large group fully insured composite rating, because those are calculated in a different way. But in small group, the composite premiums for small group ACA plans are compiled by deriving them from the total cost of health insurance under the age-banded method. So what the government has said is that in order to calculate your composite rates, you're going to take a group and you're going to rate it according to the age rate method, and then you're going to get a group total. And the group total is just the sum of all of the costs for the employees that enrolled on the plan on day one. So when we add all these columns up or these rows of data for the age premium year one column, we get a total of $5,099. And so the composite rates must be built out of a formula that's established by law that will work that number backwards and that population information backwards to create the composite rates. And so those composite rates are calculated here. You can see that they correspond to the prices assigned here, and the prices are assigned by the tier. And when we take this column and add it all up, we get this value here, which is $5,099, and they match, which is what they should do. So on the start of the plan year, the composite premium in total, group total, must equal the age-banded or age-rated total in total. So take the entire cost of the group under age-rated, the entire cost of the group under composite. They should be equal in order to be complying with the composite rating rules. So the distinction is that as we move on into the year, the population is going to change. And so those population demographics no longer apply. And so now we're going to start to get inflation on the cost of the insurance as we change employees. So I'm going to simulate some hypothetical turnover here. And the way this is going to work, it's going to take the census, that broad census I showed a moment ago, and every month we're going to lose one of the existing employees and we're going to hire a new employee. So we move into February, we lost employee ID 1 and we hired employee ID 7, and their information is here. The composite rates themselves don't change, but the cost for the entire group does change. when we apply the composite rates, and you can see now we're spending $200 more than we would have if we had been on age-rated. Now let's go into March. Now we're paying $700 more. And that's because these composite rates were based on the average of the original population. And one of the things you'll notice here is that our initial population was older, and our population is now actually starting to get younger. All right, so now we're going to go to, let's just go ahead and jump to August. And this is where we'll get the most drastic effect. So by the time we're at August, this employer, and we've had a lot of turnover in this employer, and that may not be realistic for all employers, but this is just an example. For this employer, our turnover has resulted in pricing inflation or cost inflation, where we're paying $2,000 more per month than we would have been paying if we'd been under age-banded rates. And so, I mean, obviously that's a lot of money, especially for a small group of this size. So, obviously that's a problem. And now let me show you one other thing. Let's go to the renewal now. And at the renewal, at August, we stopped the simulation. So at August, from August forward, the employee population stays the same. And what we're looking at here in this composite column now, essentially this represents the December premium. And so I'm going to go ahead and write that down so that we have that. And then what we want to do is we want to renew the plan. And so we're going to go ahead and renew the plan. And when we renew it, the carrier is required to re-rate. And the reason they're required to re-rate is because we have a new population, and the rules state that the premium has to be in the start of the plan year. The premiums for age-banded and composite has to be the same. And now that we're dealing with a younger population, they're required to re-rate and bring those composite rates down to reflect that. And so here are the composite rates that are now calculated out of the enrollment for January 1st, 2022, a year later with a younger population. And we're looking at now the column totals. As you can see, they add up. So on January 1st, 2022, the premiums are equal, but the difference from December of 2021 to January of 2022, 4751 versus the 6,664.20. And just to do a little bit of math here, oops. Oh, no, that was based off the wrong amount. Okay, so the difference is 28%. So this employer is going to get a 28% reduction in their premium, which on the face of it might sound good. If someone said, hey, my client got a 28% premium reduction, our first reaction is to be excited about that. But when you realize that the reason they got this reduction was because for the last year they have been overpaying insurance because of the composite rates and their population actually becoming younger through turnover, that's not actually a great position to be in. You might have a frustrated client there. Okay, so there is that case. Now, if you've sat through and watched this up to here, the question you might be asking yourself is you say, well, Eric, that's fine, but you did that with the assumption that you've got a base population that's older and you move to a younger population. If we started with a younger population and moved to an older population, isn't it true that we'd actually be on the winning side of that effect? Wouldn't the company actually be saving money? And the answer is yes, and I'm going to demonstrate that. But where this is going to come back and bite you is at the renewal. So we're going to take another census, and it's actually the same census, but what we've done in this case is we've reversed the order of the enrollment. So now the younger employees will enroll first, and the older employees will enroll later. And so we'll base the composite rates off of the younger population first. So let's go back to January 1st, 2021. And here are our employees now. So we're enrolling with different employees. You can see that the employees are younger than they were. And our composite rates are now calculated to be lower because they're based on the cost of younger employees. So now let's move into the validation of the composite rate. So this is the premium total for the age-rated premium. and now the composite premium total is equal. So now we know that our composite our composite rates have been calculated correctly. So now let's just run the simulation. Now let's do the same thing. We'll go into February, and you can see in this case you're actually paying more with composites. We must have picked up a family or something along those lines. Now let's move into March. And now in March, you're actually now starting to save some money with your composite rates. So exactly what we predicted. We're on the winning side of composite rates until we get to the renewal. So now you're saving about $200. The one thing that you'll notice as we go through this, though, is that when you're on the winning side, the amount you win by doesn't tend to be as much as you would lose by when you're on the losing side, even when we use the same population of employees. So there's some probabilities reasons as to why that is, and I think that might be interesting for a future video, but for now it's just good to know that being on the winning side is you don't win as much as you could lose when you're on the losing side of this. Okay, so we're now looking at April. Let's go ahead and just jump ahead to August. And now we've got a $1,300 difference. Before it was $2,000. That's how much we were losing. Now you're on the upside of $1,300, which is still significant. Obviously, if you could save your employer $1,300, especially when you're looking at a total premium of $4,000, that's a lot of money, especially proportionately to the cost of the insurance. I mean, that's a good thing almost, except here's what's going to happen. So now we're going to go to December, and our rate shouldn't change because the population won't change. And that's correct, and I'll just come down to this cell here, and we're going to write down our December premium, which was $2,770. And now let's go ahead and renew. So when we renew, we have to re-rate the composite rates to a slightly older population now. And, oops, that's year one. Let's go to year two. So now we have higher composite rates to reflect the older employees. Just to check, our January age-banded rates are 4,300, and our January composite rates are 4,300. So our formula is checking out, and we've got a $4,300 premium starting in January. Our premium in December was $2,770. So just to give you an idea, we'll go 4,300 divided by this, and you're looking at a 55% renewal, which, even though you were on the winning side for last year, that's a huge budgetary hit to take. And as a reminder, this group was imputed a 4% renewal on the age-banded rates. So even when you factor aging up, throw another 2-3% on there, even if it was 7% in total, when you have the age table rate up plus the age banding rate up, that's nothing compared to 55%. You know, that's a huge hit on an employer, and they're not likely to respond to the average of the experience. Okay, that's a thing I learned a long time ago. People, customers, they don't relate customer experience on the average. They respond to the variation. And what this is telling me is that regardless of which side of the coin you're on, you're going to have massive experiences of variation to account for, and that's going to lead to a lot of dissatisfaction. Now, one of the challenges you might have is you might have an insurance carrier that refuses to do age-banded rate, or age-banded is something else, age-rated costs, and they might insist on doing composite rating. There are states where that's pretty much common across the entire state. So what do you do there? I think what you do is you explain to your employer how this works, and then you help them understand that at a high level, the way they need to kind of set their expectations is that the higher the turnover, the higher the variation they're going to expect. If a company has low turnover, the effect won't be this drastic. But the higher the turnover, that's the thing that is going to widen the range of experience. And it's hard to know unless we know the way the turnover is going to change, how demographically, how it's going to change the group. So it's hard to say whether it'll be on the winning side or the losing side. But what we can say for certain is that there's downsides in either direction, and the range of that variation is going to be affected by the volume or the amount of turnover that happens within that group. So ultimately, I hope this is informative to you. I hope it gives you enough to have some really strong conversations with your clients to set you apart, make you look like you have your knowledge locked down. And we'll provide more of these videos. We'll catch you in the next video.